Good morning, everyone. This is Scott. We are going to discuss the March 22nd TLT Elephant today. Because this is our first recording here, we're going to do a little basics on the trade itself, a little background on the trade design, the underlying, and that kind of thing. So let's just begin with the trade design. Basically, obviously, the trade name came from the elephant appearance in the P&L graph. Um, the key to the trunk of the elephant for this trade is this is essentially built-in black swan protection that we have on the trade. We're trading treasuries here, so TLT is indeed is indicative of the 30-year bond. A 5 basis point move in the 30-year treasury bond will be a $1 move in TLT. So the issue that you have with treasuries is gaps higher in price, lower in yield. As a reminder, prices move inversely to yields in the Treasury complex. So if we have prices going higher, yields will move lower. And that will be represented by TLT moving with the price of Treasury bonds. So if Treasury bond prices are moving higher, TLT will move higher. That's yields moving lower. Now, that typically will happen in times of panic. When you see a big surge in Treasury prices, big drop in Treasury yields, it's typically some type of shock to the system. So we saw some of those things play out in the last several years. We've got many examples of it. The most recent really is the miscommunication from the Fed that we had over the last 12 months. Really, prior to that, we had the Turkey issue that really caused some pretty major moves, and Brexit, China devaluing currency, that kind of thing. So that kind of thing, you can wake up in the morning and see yields down 10, 20 basis points, and that's what we're worried about. And that's why we have the built-in black swan protection. Now, like I said, Treasury, there tends to be panic buying in Treasuries, not panic selling like equities. So very rarely, if at all, especially in times of low inflation and a Fed that's on hold, will you see panic selling of Treasuries. It just doesn't happen in times of low inflation. Certainly in the 80s, yeah, different story. But today, with inflation anchored at 2% and not looking like it's going to change anytime soon, we can control the downside move. There's always a bid for treasuries. We have sovereigns, we have pension funds. So there's always going to be a bid for treasuries. Not to say that yields can't move higher and prices can't move lower, but they tend to be controlled, and we can easily manage to the downside because it tends to be slower. Where we want that protection to the upside in case it's just a gap that we can't manage during market hours. So again, panic selling doesn't happen in treasuries. Panic buying happens in treasuries, and that sends TLT higher. Selling is more controlled, and you can see we start off delta negative here, but I'll get into that in a minute as far as the trade design, the current trade. But that's the overall design. So let's back up and go back to the Treasury complex here to get the basics there. And then we'll go back to the trade that we just opened. All right, so take a look at the whole curve here, and you can see how flat we are. We're most concerned with the 2 through 30. But if you look at the entire curve, you see, the 1 month, the 3 month, they're not moving anywhere. The Fed funds rate is a range of 2.25 to 2.5. It's currently trading around 235, 240. So the 1 month, 3 month, this is where they're going to stay. 6 month, you get a little premium, for being 3 months out. And that's it. We're going to sit here until the Fed gives us indication on its next move. So that the Fed completely controls the short end of the curve, and the short end influences the long end. But now the influence is greater because the curve is so flat. There's no place for yields to go here. We've got a 230 spread, which is under 50 basis points, but it's held at 50 basis points for the past 12 months essentially, and the 1030 is held about 15. It's a little lower than that right now, but so they've really been moving in lockstep. So we know that the front end is going to control the 2, and if the 2 is moving in lockstep, or I should say the 10 and 30 are moving in lockstep with the 2, we have a pretty good indication of where they're going to go. And my thesis is they're not going to go very far. They're going to go sideways until the Fed makes its next move, which is unlikely to be this year. There's a 10% probability of a cut. There's a 10% probability of a hike, which means it's basically status quo for the near term. So that's what we want. It's a great environment for the trade. And as far as the 30-year is concerned, overall, the 30-year trades in a channel. You can see that before this was when the Fed had a communication problem. You know, at that time in October, it was believed the Fed was going to hike 2 to 3 times in 2019. And the whole curve moved with it. It wasn't just the 30, but you can see here how much the short end has influenced the long end. You know, in the last 12 months, look at, you know, it was almost identical movement in the 2-year and the 30-year during that time. You know, huge spike up in yield. 30-year, the 2-year was pushing 3%, you know, which is 10 years below, and actually the 30 years below that at the moment. Won't stay there in my opinion, but you can see this is the miscommunication, and then Powell walked it all back, and far from neutral, he said back here, and then it was basically, oh, we're basically at neutral, capitulated to the markets, and then, you know, the 2-year found its home right on top of the Fed funds rate. And the 30 years found its home, you know, about 50 basis points beyond that. So I do believe the 30-year will stay in a channel around 3%. If you go back, you could go back 5 years, and you know the channel is there around 3. It's just it's hitting outliers based on, you know, shocks and lack of communication from the Federal Reserve. I don't know what we're going on here. Bear with my computer. Just bear with me here. All right, well, you know what we'll do instead? We'll just take a look at the price chart on TLT. So let's go, that's a little more granular. So let's go and just look at the channel. You can see it. You know, and this is indicative basically of the yield on the 30-year, but it's actually less complex and more simple just to look at TLT, knowing that TLT moves up $1 for every 5 basis point drop in a 30-year bond. So you can see the channel now. You know, we've regained this channel. There it is, and there it was all through here, and this was basically when the Fed was 50 basis points lower. And, you know, the long end was basically waiting. And this is where, you know, Powell said we're a long way from neutral. And yields started rising in the 30-year, which meant prices went down on TLT. And they went way down. Look at that. It's a crazy move for TLT in that period of time. This is something that's standard deviation is 60 cents a day. And it went basically $10 down and $10 up in a matter of a few months. It's just crazy. And it's 100% related to Powell's comments and lack of communication. Now it's crystal clear, which we like. They're, you know, at this point in time, we have crystal clear communication from the Fed, so they're not enemy number one anymore. Inflation is still at bay, anchored to 2%. Those are two of the biggest influencers on Treasury yields. So if they come out of our, you know, they're out of our way, well, we should bounce around in these levels. And if we bounce around 120 to 122-ish, 120, 123, that's where we can make a lot of money just selling premium. So let's get to the trade. Here's the one that we just opened on Friday. It's a little bit of a modified version. I didn't sell any call premium because it was a short week. And you know, IV is really low on the call side, so it didn't really appeal to me. These IVs are not aftermarket, always be cautious. So the IV was actually more like in the 8s, 9 on the call side. I didn't want to sell it, much of it, you know, if any. So I didn't sell any at all. We put the hedge in on the 50 strikes of the 125 calls. That's in there, and we'll look to sell potentially some premium next week on the call side. Depends on the price action. I want to be delta negative here at 122 and above. So we are. At 122, you can see we have nice delta negative. And this is forecast for Tuesday. So if we come up, anywhere that we traded in the last couple days, forecast to make a 4 or 5% gain just over the long weekend. And then we look to modify. So we've got 8,400 in margin that's being used. We have some dry powder, and there's just a ton of adjustments we can make. This trade is very discretionary, everyone. So it's not a rules-based trade. Okay, it's based on my knowledge of the Treasury market and discretion therein. However, those that follow closely, they can learn what I'm doing and kind of make the trade their own. If they feel like they want to be more delta negative or more delta positive in certain situations and may disagree with my outlook, they can do that. And that's kind of the key here, is to learn how to do this so you can do it on your own. So this is how we look for this week. We'll wait on adjustments. And, we don't chase the tape, we trade the tape. It's a short-term trade. We're selling premium every week. So again, we've got a debit spread on here for March 22nd, and we're going to sell premium against it every week. So we've already got this week loaded in. We'll sell a little bit more premium, hopefully during the week. We'll close these credit spreads on Thursday or Friday, or start scaling out on Thursday or Friday while we sell the next week's. Okay. Now, this one, we're definitely going to close this on the 28th. I typically would hold it a little longer. We did, our debit spread is the March 22nd. I typically would hold until 2 weeks before, but the one day of the month is the first Friday of the month is the labor report. And the labor report is the big mover for treasuries because we've got the wage inflation data. So we want to be out on that and wait for it. Let's let it settle, and then we can open the new trade that afternoon, probably on the 1st. So we'll look to sell more premium for this week, and then start selling for next week. Get out of it on the 28th, and then open the next one, which will be probably the April 15th or whatever the April monthly is on the debit spread. The 19th, so we'll have a lot of time to sell premium against that next debit spread. It'll be a whole month of March into the first week of April. So that'll be the next one. So that's where we stand now, and we'll look for adjustments this week. Hopefully we come up nice and soft in this area, and we'll take it from there. All right, everyone, have a good rest of the weekend. Next update will be next weekend, either Saturday or Sunday, likely Saturday. Take care.